Hi guys, welcome back to Father and Son Investing. By now, most of you are probably aware that Silicon Valley Bank failed last week. Part of the reason for their failure was tied to selling government securities at a loss, which if you are a holder of a Treasury bill, a Treasury note, or a Treasury bond, may lead you to ask, what does that mean for my Treasury bill, note, or bond? So today's video is going to cover that. The video today will then have 6 topics in order to discuss how this Silicon Valley Bank collapse will affect your US Treasury securities. Number 1, I just want to give a brief overview on how this collapse actually happened and how it was tied to US securities. Then we're going to talk about bond yields and bond prices and how changing interest rates affect those. That will lead us to something called interest rate risk, which will be item number 3 that we'll cover. Then we will talk about how this SVB collapse affects the current U.S. security prices. That will lead us then to how does this affect your current U.S. securities, the ones you currently hold. Lastly, we're going to wrap up the discussion just by talking about strategy for U.S. securities. Should you be buying more? Should you just be holding what you have? Or do you want to think about selling your U.S. securities? Let's just talk about item number 1, what caused the Silicon Valley Bank to collapse and how is that tied to US Treasuries? To do that, we need to go back in time to 2020, near the start of the pandemic, and we'll see that between 2020 and 2022, their bank deposits almost tripled. That led to a huge amount of money that they had sitting in their bank, and guess what banks do with money? They either invest it or they loan it. Now, of course, one of the safest investments on the planet is considered U.S. government securities. So Silicon Valley Bank bought U.S. government securities with all of this excess cash. Here's the problem, though, with their purchase of U.S. government securities. They were purchasing between 2020 and 2022. We can see that the yield was anywhere between 0.64% and up to, we'll call 3.25% in June of 2022. However, U.S. security yields have continued to rise. On the 10-year, it got up over 4% in October of 2022, and just recently was approaching 4% again. Now, we'll talk about why this was a problem when we hit the second and third items of business, which have to do with bond prices and yields and how interest rates affect those, and something called interest rate risk. Let's get back to the story, though. We'll take another look at the Silicon Valley Bank deposits in a bar graph method. Again, we see this huge influx of deposits into their bank. But then in 2023, we start seeing outflows from the bank. What was causing these outflows? There may be a number of factors, but a big factor was rising interest rates. As interest rates rose, companies find that their costs of doing business increase, and they had to start tapping their financial reserves in the Silicon Valley Bank. That led them to withdrawing money from the bank, which led to outflows from the bank rather than deposits. The bank is required to maintain a certain amount of capitalization, a certain amount of cash that's available to them. When that money is exceeded in outflows, they then need to recapitalize their bank, and in order to do that, they decided to sell their U.S. securities. Now, that in and of itself was not a problem. However, on Wednesday last week, the bank announced that they had sold their U.S. securities at a $1.8 billion loss, and that they were going to be selling stock in the bank in order to raise another $2 billion plus to recapitalize the bank. Now, that then led to some fears by venture capitalists who advised their clients, the people that they loan their money to withdraw their money from the bank, which led to a run on the bank. Such that on March 9th, there were $42 billion that were withdrawn from Silicon Valley Bank, causing its collapse. That might lead you to the question then, why did the bank sell their securities at a loss? What caused that loss? To understand that, we need to understand the way that market interest rates affect the prices of fixed bonds and their yields. To explain that, we'll just look at this simple graphic here. If interest rates rise, the prices of bonds will fall and the yields will rise. Therefore, if interest rates rise, yields rise. That makes sense if you think about it. If the interest rates go up to 4%, people want to get a bond that will give them at least 4%. Conversely, if interest rates fall, the bond price will go up and the yield will fall. So if the prevailing interest rate goes down to 2%, we can expect that the bond interest rate might come down to 2% as well. That's going to lead us to our next item of discussion, interest rate risk. Let's just say that today the market interest rate is 3%, and 1 year later the prevailing interest rate goes down to 2%. Well, that bond will pay 3% regardless, but the value of that bond will actually go up in this case. Remember, if interest rates fall, then the value of the bond will increase. Conversely, if 1 year later the prevailing market interest rates go up to 4% and we are holding a 3% bond, remember the value of that bond, the price of that bond is going to come down. Why? Because people who can purchase a bond at 4% are less interested in your bond at 3% unless you're going to discount the price such that they can get 4% for them. In order to do that, you're going to have to sell that bond at $925. Thus, you will have lost $75 on your bond. We call this interest rate risk. And what interest rate risk is, that the value or the price of your bond, what you can get for it, will go down if interest rates rise above the interest rate or the yield on your bond. This interest rate risk really only applies if you need to sell it. If you hold your bond to maturity, you will get back your full $1,000. But if you need to sell it before it matures, you're looking at a loss potentially. Now, that is what happened to Silicon Valley Bank. They had to sell their bonds at a loss because they had purchased them at a lower yield to what the prevailing yield was now. And again, once they announced that they had sold their bonds at a loss and announced that they were going to be selling more stock to raise capital, that caused venture capitalists to advise their clients to remove their money from the bank. Using a graphic to help us remember that when yields go down, bond prices go up, let's just take a look and see what happened with SVB's collapse and what that did to the 2-year Treasury note. Here's the headline for today, Monday, March 13th. 2-year Treasury yield posts biggest 3-day decline since aftermath of 1987 stock crash. Just how much has it declined in 3 days? Well, as of today, the 2-year Treasury was last trading at 4.07% as of the time of this article, which was down 52 basis points or half a percentage point. And compared to 3 days ago, 3 business days ago, the yield had fallen 100 basis points or a full percent on the yield. Now, it's not just the 2-year Treasury note that's happening to. This is happening to all of the US Treasuries, as you can see here across the board. That leads us to the next topic for discussion. Again, going back to the graphic, if the bond yields have fallen like they have drastically in the last few days, what is that going to do to the value of your bond? That all depends on what the current yield is on your bond. What do I mean by that? It's really quite simple. If you have a bond that has an interest rate or a yield higher than the current market rates, the price of your bond will go up. If you have a bond that has a lower yield than the current interest rates, the price of your bond will go down. If you possess a treasury bond, note, or bill that has a yield the same as the current interest rate or the same as the current yield, then your price will remain flat or the same. So in order to know what the current change in the price means for your US Treasury, you simply need to go look at the current yield on your US Treasury that you already own and fit it into one of these 3 situations. All right, lastly, let's just talk about strategy. Should you be selling your current US Treasury? Should you be just holding your US Treasury till it gets to maturity? Or should you be thinking that you want to buy more now? That all depends on your specific situation, which I can't tell you exactly, but we can cover some of the thought processes that go into this. Let's say you're thinking about selling your US Treasury. That depends on whether your US Treasury went up in value or whether it went down in value. If it went up in value, you could potentially make more than what you paid for it. However, remember that if you want to reinvest that money, you won't be able to get it at that high rate that you already got. You're going to be investing at today's US Treasury prices. So keep that in mind. If the value of your US Treasury bond, bill, or note went down, then you need to decide how badly you need that money, because if you sell it, you're going to be selling it at a loss, similar to what Silicon Valley Bank did. For many of you out there, the answer will just be to hold your US Treasury bond, note, or bill to its maturity, at which case you will receive the full value for that US Treasury. The last question then is, should you be buying more US Treasuries now? That depends on what you think the future rates will be on US Treasuries. Now, we know that Jerome Powell and the Fed have been saying that they plan to increase the Fed funding rate, the rate that banks pay each other, and thus the interest rate that we're all going to be paying when we borrow money. There's a good chance that they're going to slow down on that with this bank failure, as well as another bank failure that happened over the weekend. However, there's no guarantee of that, and I still believe that the Fed is going to be raising rates, although it may be at a slower rate. So the question is, do I think that I could get a better price on a Treasury bill in a couple of months or so? If the answer to that is yes, then I want to buy a short-term Treasury bill, like a 4-week or an 8-week Treasury bill. If the answer to that is no, I think that those rates are going to be coming down even lower, well, then I want to buy a longer term, say a 2-year or a 10-year note. I personally think that rates will go up in the future, and so I'm looking at shorter term Treasury bills. Feel free to leave a note in the comments about what you think will be happening to US Treasury rates in the future and what it is that you're going to be buying right now. I hope this information was informative for you. If it was, please give us a thumbs up and share this kind of information with a young person in your life. And as always, until next time, enjoy your investing.